we're here to chat about structuring property developments, all about that. So, we're going to get into that in the next few minutes. But before we do that, we're just going to kick off with a quick introduction to Inspire and us, who you've got running you through the webinar today. So, my name is Ben. I run an accounting firm called Inspire, and one of the things we're fairly well known for is helping our clients save a heap of tax, and that count is up to $28 million. That had a big boost in April, May, and June just recently. But that's what we're sort of focused on is paying your fair share in tax, but not a cent more, and making sure we're doing what we can to make that happen. In terms of personally, I started Inspire when I was 23. I'm an award-winning accountant with over 17 years experience now. I'm the author of a book called Wealth for Life, and almost going to be an author of another book. I sent the manuscript off for edit on Monday. It was a painful process, but it was. It's ridiculous.
It's a big process, but yeah, it's awesome to see you adding one more to the collection, Benny.
That's it. So that one will be out in November, and that is all about tax and structuring, and a little bit of what we're talking about today, actually, quite interestingly. Riz, would you like to give a quick...
Yeah, thanks, Benny. And yeah, my name is Riz. Some of you might have worked with me before, but if you haven't, I'm one of the associate partners here and a chartered accountant as well. I joined Inspire back in 2016. Recently became a new dad to my baby boy August. You can see him smiling there in the bottom corner. And currently, just sharing, I'm doing a 350 kilometer ride on my Peloton to raise some money for sick kids as well. So if anybody wants to donate, let me know. I can send some links out. But I'm proud to say that, with the clients that I work with, I've been able to save them quite a bit of tax in the time here. And in 2023, we were able to save up to $2 million, upwards of $2 million in tax through our proactive tax saving advice that we give every year. So yeah, it's been an awesome journey. And I've done a few webinars like this with Ben before. You might see me before, but I'm really excited for today.
Awesome. Wunderbar. All righty. So just before we get stuck into it, I do want to sort of shout out if you are you're an existing client and something, because there are a few clients on the call today and something you want to debrief with your accountant, please feel free to reach out to them and book a chat in with them. If you're not a client of Inspire, then the link to book in a strategy call with one of our accountants is in the chat box now. So that is an option if you do want to explore something in the webinar or working together. Cool. All righty. Now, we're talking about property development today, which is very different from rental properties and buying an investment property to rent it. Mm-hmm. So just want to get that framing really clear at the start. It's how do I sort of describe this? It's not a extremely common thing that every second person goes and develops property. It's extremely high risk. I've noticed that a lot of our clients have some sort of industry knowledge, whether they're a builder, they know a person who develops and they're getting guided by them. They're a real estate agent. They're I don't know. There's some sort of connection to real estate already in pretty much every single client who we've helped do this sort of stuff with. So and we're not here to sort of, share the strategy on how to actually carry it out from a, construction perspective or, who to line up, what trades to use. That's not our perspective here. It's all about how do we structure it from a tax perspective. And in fact, I think that's on my next slide about the key things we're going to go through. But examples of development we're talking about is, splitting a battle axe block, putting a line through the middle and selling the land, or building two houses and selling it. Splitters, same sort of thing. Knockdown rebuilds, building duplexes, knocking a big house down, building townhouses or apartments, big land subdivisions. And the good old builders love these ones. The good old speckies, building a specky home, which buy a block of land and build a house to sell it pretty quick.
Yeah. I guess just to add, and like I've seen a lot of people starting to get curious about this. They might not have had experience before, but they definitely tickle their curiosity, because usually people start in the normal kind of way of getting into property. They buy a property where they live in, or they then rent it out, and they go, oh, okay, well, I kind of know what property is. It's not such an enigma like, you know, the share market or the ETF market is something that people know really well. I think especially in Australia, there's a big fat infatuation with property and development as well. So it's a very common topic, and I understand people's curiosity today. And hopefully, we can provide some value in showing you how you can structure this best.
Beautiful. And what I would love to know is if you're considering or doing, or you've done developments, I'd love you to pop in the chat box what type of development. What's it been? Is it a knockdown rebuild or a land subdivision? That'll sort of help better frame where Riz and I go in the webinar today.
Yeah, that would be really helpful, because we do want this to be super valuable for you guys, and relevant is the most important thing. So even if it's just it's a curiosity thing, drop that down as well. You just want to know what the kind of ins and outs of the structure looks like. Just let us know in the chat box. It'll draft the conversation a little bit better.
Yeah, perfect. Very good. All right, knockdown rebuilds, bit of a duplex happening, granny flat, land sub. Awesome. Very cool to hear. Wow, Sonny's got a few.
Yeah.
Very cool.
Oh, and yes, yep, awesome.
All righty. Well, the different sort of sections of today's webinar, we're going to talk about this thing called business or capital. That's sort of the first thing we're going to run through. We'll have a chat on funding, the development itself, because I think there's a couple of unknown tricks that we can use through the structure that we choose. We'll talk about tax on tax. There's literally, I think there's like 5 or 6 different taxes to consider with property development, and then also example structures. So we'll chat through. I think there's about 4 different types of structures we commonly use. And when we're talking about structures, this is not the be all or the end all. How we sort of work with this is the client tells us what they're looking to achieve. They've got X property. I want to do this with it. They've got these partners. This money's coming from here, and then we're putting together the structure that will make that happen in the most tax effective and commercial way possible. That's the point of the structures, but we'll have sort of 4 building blocks of structures that we use to make it happen.
Awesome. And I've got a question for Brad here about what about develop and hold for investment? That's a good point that you bring up. It's kind of like a gap that you saw in that list, but
not at all.
It's less of a flip, but it's still considered development because you're building it, right? But there's kind of 2 parts of that transaction: is during that process, and also what happens at the end, whether you sell it or hold it. We'll cover a little bit about how that affects a few things from a tax perspective as well.
Yeah. In fact, that's a beautiful segue to business or capital.
Yeah.
Cool. Well, Riz, did you want to?
Yeah. So I guess the from a high level, there's kind of two ways that you can make income here. You can either go into business as a call it a property developer, where this is from the ATO's perspective. What they're looking at here is whether or not you're going into business here as a property developer, or you're put it quite simply, is that you're holding it for capital growth or long-term growth. And essentially the key difference there is the tax outcome out of those 2 things. Now, as you know, as a business, you're running the business, and there's going to be a different tax outcome versus, let's say, holding a property long-term for capital growth. So here's some like quick dot points there. Like most, if you're going into property development with that in mind, trying to create profit, trying to flip it, and trying to continually make money through flipping properties, then most likely it will be a business. So usually what we see in practice is most property development gets caught under this business section. Now we'll explain further how that vein kind of goes down the track. And also, the good thing about that as well is you can kind of choose the best tax structure or the best structure to operate your business in as well. Now, from a capital perspective, it really is kind of stuck for long term. We use the word stuck, but it's essentially long term growth and long term plans here. Now, because it's a capital in nature, there's a different tax outcome as well. And we'll go through that in a second. There is a potential for it to be a better tax outcome on a very high level, because there's some really generous exemptions, like the main residence exemptions and things like that. However, again, it's not about picking it. It's kind of like, it is what it is a little bit. And we want to be careful trying to mitigate it and trying to put it in a certain box. If we're going down the route of, here's a profit-making enterprise, and we're going down a business route, then let's just understand what that looks like and play in that vein, versus trying to flip it over. Because this is also a contentious part, because can be subjective. If I just do it once, does it count or not? It can be quite subjective. There's a lot of case law around it, and there's a lot of resources from the ATO to make sure that we don't play with fire here.
And just what we've done with clients in the past is where this is a bit murky. Like, usually it's really clear, it's just really clearly business. But where this is murky, let's say the person's, it's their own home they've owned for 20 years or so, and they're looking to just make the most of the asset on sale. Like, there's elements of it being a little bit murky, or both. So that's where we've sort of literally gone into just purely done advice on this part first before we sort of work out even what we do with the development. So it's a tricky one, but and I think
the tax outcome is wildly different too, right, Ben? Like it can change, it can swing quite a bit. So it is what Ben mentioned about being a separate almost advice to look at this is important at the start. If you're doing the viability of the property development, you want to know what tax you're going to pay at the end of the day.
Yes. It's important. Yeah, because you don't want to make enough profit to just pay the tax bill.
That's right. That's not fun. No,
that's it. And just to reiterate something that Riz said, maybe in a slightly different way, if you're trying to make something capital, you're probably running a business. Like, if there's that real sincere, dedicated attempt, it's I think we're probably playing with fire. All right, next category: funding the development. So again, like anything with development, there's 100,000 ways to do it. And with funding it, not to go down loan advice and that sort of thing. In fact, we've got some cool mortgage brokers on the call this morning or this afternoon. But I just want to sort of mention a couple of things. And we've had clients self-fund developments. Maybe they've got enough cash to just buy the initial property, do what they need to do with it, and then sell it without needing a bank. Fantastic outcome if that's you. We've got clients who've used banks for it. Some of them have. And then there's a whole heap of ways that can be done. Often it falls in the category of commercial lending. It depends on the actual development itself, but commercial lending, which there's pros and cons about that as well. So again, with your mortgage brokers, just make sure when you're chatting with them, they have had experience with property development, and in particular, like we've got a referral to a commercial broker that we have to specifically look at this sort of stuff, especially the bigger developments, because it's a different skill set to helping people buy their first home or buy a house or refinance. It's not as simple as that.
Just to add there, it's like it's not just about finding how to fund it, but also the right way to fund it. Obviously, when you introduce leverage and stuff, risk increases, and interest rate comes into play. Then you start looking around, the economy, what's happening in Ukraine. That all starts impacting it when you start playing with a bit of leverage and interest. When you self-fund it as well, obviously there's opportunity costs with the money that you're using, the cash, whether everything goes into this, call it the one egg or the one basket that you're developing this property in. So it's all risk consideration and mitigation that you need to look into it. It's important to understand how you fund the structure very clearly from the start, and essentially getting advice around that, because there's, like Ben said, there's a million ways to do this, including even if using your own, like what we've shown here, like super funds and things like that.
Yeah. We've had client groups, especially sort of non-related families, coming together to do developments, and they've not realised there's structures we can use to basically pool their super or parts of their super funds, and be able to use that essentially as a deposit for the bank coming up with the difference. So there's really sort of advanced structures there. We'll touch on a couple of those towards the end, but I remember a client group. There was 4 different partners involved, 4 different families, and they each had their own sort of expertise they brought to the table. They didn't realize they could, chuck a couple $100,000 in each from their super funds. They met all the requirements to be able to do this sort of thing, and their threshold for what they thought the size of the development they could do, like almost doubled to millions of dollars versus what they had in mind, maybe $1.5 million development. So yeah, it does change the game when you sort of know what structures to use from that perspective. And that's where I go right back to what I said towards the start, is if the client tells us what they want to achieve, what they want to do, we can sort of guide them in the structures, what's possible.
Yes.
Yeah. And also this one.
Yeah. I know that's just too much tax on one page, man. There's actually 4 if you include the one on the little picture there.
Well, there's now five types of tax.
Oh gosh, and yeah, this is just a summary of like the type of tax that comes into play when you have a property development. Now some of them are pretty familiar stuff. Income tax, everyone pays income tax if you're making an income. Capital gains tax. We'll go through each one of them. I think they're on separate slides after this. So, but the 2 things that come into play that's not as usual is in property is obviously stamp duty and also land tax. That's more property related, and that's state based as well. The top 3 is federal tax act, the bottom 2 is state based. So depending on where you're watching this from, the stamp duty and land tax is different. The rules around it is different in each state. So that's where we sometimes work with lawyers who are experienced within that state itself in advising around the duties act or land tax act for that state itself. But yeah, obviously an important part, right? Like we want to consider if that's that much tax we have to pay, it's going to be a big outflow from your property development. So we want to be managing that properly as well.
Yep, absolutely. Alrighty. Income tax. So I guess income tax is probably what you'll so you'll pay this most likely if you're making a profit, first of all, in your business style developments, which will be most of them. And so, yeah, our recommendation is choose your structure wisely. Make sure you factor your tax outcome into your what do you call it, feasibility. That is important. All these taxes need to go in there, but definitely income tax. We're looking at maybe a 25% flat tax rate in a company, or if you do it in your own name, you might be looking, depending on the profit level and your existing income, you're looking at 47% or more in tax. If you're, let's say you leave it in your own name or carry the development out as a sole trader. So vastly different. If you've got partners, business partners in your development, the tax impact may be their own, each to their own, and how that's structured from their ownership perspective.
Yeah. And just to kind of clarify for people, so this income tax is when you lodge your tax return for whatever entity you develop that property in, and usually you don't see this until the sale has happened or later down the track. So it can take 1 to 2 years depending what type of property development you're going through, but it's usually at the tail end side of things. But again, you want to kind of know that at the start when you're doing your viability, like based on the structure. So you can see how there's a bit of like chicken and egg here. You're trying to plan everything. So when you know your structure, you know your tax, you can do you can slot that into your viability report as well. So what Ben just mentioned, different tax rates for different entities. So choose your structure wisely is our advice.
That's it. The next one, CGT. So yeah, I mean, this is sort of straightforward. You'll pay CGT on developments that are capital. So you may have developed a property, hung on to it for a while, rented it out. It's treated as an investment or capital asset. Your intention wasn't to develop it and sell it for a profit straight away. That's the sort of thing where you might tick into this capital gains box or being treated as capital. The other one is, we've had quite a few clients who they've owned their own family home and they want to develop that because of its potential. We've had in instances like that where we can still apply a portion of the main residence exemption to the development itself. There's a few ways that could happen. We could sell it to another entity, related party, maybe there's partners involved, and go and develop it that way, and they get the main residence exemption on the sale of the related party, or another one there is, when it changes its nature from a main residence, we could look to get the exemption on that timing. So again, if like we did an advice piece on just that part of the development, on their main residence exemption eligibility for clients. These things can get detailed. It just depends on the circumstances that you're in.
Yeah, and the example is an example of like a property that already is there and it existed. I lived in it, and then the intention of the use of that property changed. Where your circumstance could be totally different. You have no property right now, but I've got a bunch of cash that I want to go into property development. I want to go hunt for that first property. You might not live in it. That's that goes into a different vein of the tax outcome. So there might be situations where it's capital gains and then becomes income tax, or it starts from income tax all the way through as well. So it's important, if you have a property you're thinking of doing, this main residence exemption thing is important to get right, because it is a big difference in tax if you get that exemption or not.
Yeah, beautiful. GST. Oh, Riz.
Yeah, a bit more dot points on this one. So with GST, it's again a separate type of tax, but essentially it's on the transaction itself. So it's not on the profit of the property development, unlike the income tax and capital gains tax. The GST is kind of it's like whatever you buy, right? You buy a can of Coke, there's like 10% GST on that. It's exactly that, but on a bigger scale on the property itself. Now it's usually when you make what we call a taxable supply, it means that in the furtherance of a business or an enterprise, then what happens is you have to pay GST on that. That's in a different GST law act, but there are some kind of concessions, or not concessions, but I guess ways to kind of help out with the GST bill. So why is it important? It's like everyone always kind of considers why is it important, because you have to understand at the end of the day, when it comes to selling that property from a buyer's perspective, let's say you built it up and then Bob and Jane come and look at the property. We love it. They look at the price. You don't sell the property $1 million plus GST. You sell it usually, here's the price, $1 million, and there's GST component played in there. Now, the issue about that is that's not your money. The GST is going to be the ATO's money. So again, kind of like the income tax side of things and capital gains tax, you want to include that in your viability, because that's going to be not part of your profit at the end of the day. So when we look at GST, one of the main things that people, we've got a few experienced people here with property development, is the margin scheme. So the margin scheme, put it simply, without going through all the dot points yet and formulas, put it simply, it's a way to help you with cash flow with GST. So that's important, because when we talk about the GST, if you purchase something with GST attached to it, you can claim the GST from the ATO as a refund, and then when you sell whatever that thing is, you pay the GST. So it's a pass on tax, and that's how GST works. And it's usually the final person who buys, Bob and Jane, who buys this property, actually pays that tax to the ATO. The issue about that is, if I have to buy a property at the start, right, and there's GST included in there, my funding, my deposit, and all that stuff comes into play. I have to fund the GST proportion as well. Yes, I get a refund of it, but still, when we talk about hundreds and thousands and millions of dollars, it's going to be a lot of money to wait for that refund. Now, later down the track, when I sell, yes, I collect GST and pay it to the ATO. Again, it's another funding issue as well. With the margin scheme, what it allows you to do, without again going through the eligibility just yet, is that you're able to kind of only pay GST on just the difference between the purchase price of the property and the sale price. So the margin between those two. The reason for that is you don't have to fund it, essentially. You don't have to fund the GST, and you only pay on the difference, which is fair, because you're essentially paying only GST on the profit you're making on the property itself, just on the sale price and the land.
Yeah, not the total sale price itself.
Yeah, not the total sale price itself. So there's a few gates you have to pass. You need to obviously be registered for the GST. That's point one. Number two is it has to be a taxable supply, like I mentioned. Now, point three here, the property that you purchased to develop, you must have not paid GST originally when you acquired that property, or the previous owner had used the margin scheme as well. So it's kind of like it's a rolling that margin scheme into another developer, and that can happen. And we've seen that happen in situations where someone tries to buy it, develop it, they bought it in a margin scheme, but they couldn't finish it, and then they sell it on to someone else because there was margin scheme done. You can roll that margin scheme to the next person as well. The other thing you have to do as well is you need to obviously let all the parties know, buyer, seller, that you're using the margin scheme, because that's important. In the sale contract, usually there's a like little tick box that says that, and essentially the calculation here is that the GST is just calculated on the margin. So you can see that in the bracket, it's the sale price minus the purchase price, excluding any costs. So like stamp duty and stuff like that, it's not included in there. So it's really just the margin on the property that you bought to develop itself. So you times that by 1/11, and you get that GST that you have to pay at the end, not when you buy that property. So which is nice. Now, the other point on GST as well is the cost of developing the property. Like I said, it can take about 2 years or 1.5 years, depending on the type of property. While you're developing the property, more likely than not, there's no income, or maybe there's rental income for a short period. During that time, you're incurring all this costs. Now, if you're registered for GST, you can claim the GST on those costs. Things like, your architect fees, your consultant fees, your builder, there'll be GST on that. You can claim that. Interestingly enough, that helps as well from a funding perspective. So you need to consider that from a cash flow perspective, because you're not paying the full cost. You'll be able to claim the GST on that. But yeah, so there's a few moving parts there. But when we look at GST, it's usually also included in the plans. When you look at the property that you're buying, can you actually use the margin scheme? We want to be getting advice around that. Just on that part of the tax side of things as well.
Yeah, and the best thing about that is Bob and Jane, or whoever your fictional characters were, I've never seen them care that the margin scheme's used or not. When you, as the developer, sells to them, they can't go and claim it. It's their house they're going to live in, or a rental they're going to rent out. And yeah, I've never seen anyone worried about that from a Bob and Jane perspective, like the end buyer.
That's right.
Yeah, where you can use it, absolutely.
You want to, yeah.
You want to, yeah.
Absolutely, yeah.
All righty. Next tax. Oh dear, stamp duty. So yeah, this is state based. Pardon me. And who pays stamp duty is who buys the property. So that could be you as the developer buying your initial property to develop it, and then Bob and Jane, whoever you sell to, will then pay stamp duty again on that transaction as well. And it's something that again you've got to consider what the laws are in your state around that. There's been a bit of movement in stamp duty laws around, particularly the southern states recently over the last few years, and that might roll through. I think they're looking to sort of potentially head away from a transaction cost and more to get you on a subscription, an annual subscription of some sort of land tax.
Yeah.
So interesting to see what will come out of that. But again, something else for your fees.
Yeah, and it's important to understand that one, like all these taxes, right? They don't form, you look at it as just transaction costs, as you know, from a bank's perspective as well. It's just money that you have to front to be able to play the game, so to speak, So it can be sizable, right? It can be hundreds of thousands sometimes. So funding that is very important, and more often than not, that needs to be part of the cash available at the start when you play the game. So very, very big consideration. Again, when we look at structures later, you need to look at, all right, if we're going to access super and stuff, stamp duty is going to be a big reason for funding that, and yeah, you need to consider how much cash you have up front for that.
Beautiful. And then last of all,
are we almost done, Ben?
This is the last 5 of 5.
That's right.
Tax. Again, a state-based tax for land tax paid on holding the asset or owning the asset.
Yep.
Yeah, so Queensland, for instance, the time that counts for when stamp duty is charged is at 30 June. So we've seen developers sort of wait till the month of July to buy a property potentially to sort of skip that year of land tax. And similarly, when you're selling, there may be a small difference in land tax if you sell before 30 June versus after. And the other thing as well is some developers look to get reimbursed a portion or a share of the land tax in their contract. Buyers don't particularly like that clause in the contract, understandably. Paying a land holding costs when they weren't a landholder. But anyway, that is what it is. Land tax is just another one of those things to consider. And again, if you're depending on where you are, in which state will depend on the rules around that. When does it trigger how? Yeah.
Because it's a holding cost. So the minute you don't hold it, you don't pay it anymore. There's your timeline of your project is important to understand how long. Obviously, if you already own the property, you're already paying the land tax anyways. There is a threshold as well when you start paying land tax, so you need to be mindful of whether or not you exceed that threshold. But my point of saying holding is, that whole idea of time is money. This is where it plays in. Other than interest costs, obviously, the longer you hold something with interest, more cost to it eats away at your profit. This thing will do the same thing as well. So when you're running your kind of viability, if it's a 1 year thing, probably that's one year worth of land tax. If it's and timing, like Ben said, you could have 2 hits of land tax just because you're straddling two years worth of land tax period. So timing it is really important. So just to kind of wrap up all the taxes side of things, if this is stuff that you need to be aware of, because like Ben said at the start, you don't want to be just making profit and then paying just tax at the end of it and then have nothing, because it is a big undertaking when we talk about property developments. I'm sure people can share some experiences there. It's not as easy as just going, yep, let's just flip the property. So you want to make it worthwhile. So sometimes it's not. The honest truth is sometimes it's not, because of all the taxes as well. So pricing it and the market and all that stuff, again, we're not diving deep on that perspective, but I'm just saying this is something you want to be putting a big kind of circle around when you're doing your viability of your developments.
Awesome. All righty, now we're getting into the funner stuff, at least for us, but the example structures. So they'll get more advanced as we sort of go through. There's 4 to run through. Yes. And I sort of said at the start, we sometimes we use these as building blocks because we might have a bit more of a complex situation to deal with. But sometimes it is just a really simple structure, depending on the client. Howard mentioned in the chat about, what if all the partners want a different structure? There's kind of ways to deal with that as well, where, let's say a type of trust, for instance, you can let everyone have their own tax outcome and deal with it how they want outside of the entity that does the development. So there is ways to kind of deal with that. So again, it comes back to what does the client want to achieve? Who's involved? Where's the funding coming from? Once we understand that, we can kind of go, well, here's option 1, option 2, maybe there's a third. How do you want to make it happen? But let's kick off with the simplest, discretionary trust.
Easy stuff. Yeah. So you might have this already if you're a business owner or you have assets that you hold in a trust, but you can develop property in a discretionary trust as well. Yeah, as you know, it's the simplest one or the simple one that you can go through. The word discretionary means that there's not one person that can benefit, or only one person benefits from this. You can have a list of beneficiaries, and usually that's one family that's involved. Now, obviously, it's not a great idea if you're running this with partnerships and stuff like that. And more often than not, we're seeing a lot, especially big sizes of development. This won't fit the bill, but you'll see later down the track how that can work. It can access bank funding. You can buy property, have a mortgage on it, and then pay interest, and yeah, just as usual. You can't use the super fund unless there's other parties, but I guess that dot point is a bit of a kind of segue for some of our next structures. But the good thing about the discretionary trust is the way it's taxed. It's important to understand the trust doesn't get taxed on its own if you do a trust distribution minute the time that you make a profit, or you've already cashed in on that property. The way it works is it gets distributed to the beneficiaries. So I won't go into too much detail there, but it can be an individual or a company, and that's where you kind of manage the tax bill on that one. The running cost itself, if let's say you have the development costs, the way that it works is if you're running through the income tax side, or it's a business, the development cost actually, if it's part of the property, actually makes part of the cost of sale of the property itself. So it really is just income minus all the cost of sales, which income is the sale price. Then you get the profit. That profit gets distributed out to your beneficiaries.
So, alrighty. And then unit trust. So I'm having a coughing fit every second slide here is. So I get you to go again.
That's okay. Let's have some water, mate. But yeah, so the unit trust, it's almost one level. No, I wouldn't say level up, but it creates a more control, like a fixed. That's what I was trying to say. A fixed ownership in the assets of the trust. So you can have multiple owners with this one, where you can set an amount of units each owners hold in that unit trust. So if you want to go 1/3 with your mates to develop a property, you can use something like a unit trust. That way, that after that income minus expenses profit at the end of the day, again, the trust doesn't get tax on it. How it does that is it flows through to the unit holders as a unit holder distribution, and then those unit holders get taxed. Again, depends on who is the unit holder. It could be a company, a trust, or even another trust, or even an individual as well. Again, not much restriction. It's just the key difference here is just it's fixed. You okay, Benny?
I am okay. All right, I'll see how I go with this one.
Okay.
All righty. So the next one here is ungeared unit trust. And this is where we sort of start to see the involvement of SMSFs. Yes. Otherwise, it'd probably be called a unit trust. It still is a type of unit trust, but ungeared means you just don't have a mortgage on your property, or any sort of lending where in that trust itself. Now, the purpose of that is there is an exemption in SMSF law, self-managed super fund law, where there's certain types of related party assets you can hold as long as it meets certain conditions, and one of those is to be ungeared or not have a mortgage attached. So this is quite helpful where you've got even a single family, like just one family on their own. They want to use part SMSF cash and part cash they've got outside of super through another structure to pull the money and be able to do it. But again, you can't touch any other funding. And then even like credit accounts at suppliers get a bit funny, bit of a grey area. So cash on delivery for all your gear.
Yeah. And there's a reason why we like the next one better too, right, Ben?
Yes, that is. Yeah. And why is it not showing up?
Oh,
is that it? Unrelated. It did. Yeah,
awesome.
Cool.
Yeah, awesome. So with the unrelated unit trust here, the keyword there is unrelated. So it can't be people that you know or your associates or your family members in there. What it allows, if it's unrelated, is you can have multiple owners, including, when I say owners here, it's the unit holding as an owner, including SMSF. So when you do this, you can introduce, if it's unrelated and not one family or not one owner controls more than 50% of the units, i.e. not 1% has full control, majority control, you can actually introduce some gearing in here. So let me just put that into practical terms, right? Like when you look at the previous one, you can't have any gearing or can't borrowing. Let's use real words. Like we can't have borrowing in there. You have to have a lot of cash, and you got to really be careful on not ever owing any money on when you're running the property development. A bit tricky, right? Like we can get, obviously no loans is a simple no-brainer, don't have loans. But what if you have a bill that's overdue by 30 days? Is that technically borrowing for 30 days? So we start getting a bit complicated in the rules. Whereas here, the big thing is you can introduce leveraging. This is where Ben's example before, where he was sharing, oh, we have a bit of money, we want to develop it. Suddenly we start introducing leverage or borrowing in there. We go, well, actually we can develop a bigger property. On top of that, it's not just money outside of super. You can mix the ownership from outside and inside of super as well. So you've got 100 grand outside, you got 300 grand in super. Again, just making up numbers. Suddenly you got 400 grand on a base as a deposit that you can leverage into and play around. Now, what it allows is a bit more kind of bigger scope in what you can do. But the other thing is you can go multiple. So if there's 3 of you, there's 400 times 3. You can kind of see how, when we talk about property development, there's a lot of cost and a lot of upfront capital. That's usually one of the biggest barrier to entries to this stuff. But with something like an unrelated unit trust, it starts looking a bit more possible. But big asterisks. Whoever you go and do this with, make sure you have things like unit holder agreements. You have some sort of rules of the game, because it's unrelated. So
they're not family. They can't be family or sort of relations.
And arguably even family, you might probably want something like that too. So it's sorry, can you go, Ben?
Just like I gave an example of those 4 partners who did a development. This was a few years ago now. They came and saw us thinking, oh, they've got a couple of $100 grand outside super each. They had a bit of equity in their home, and that's what they were thinking, to sort of pool each in quarter shares. We had a conversation around super. They each had a few $100 grand each, family in that too. So all of a sudden we had almost double the initial investment to play with. So it just opens up possibilities and they were like, wow, okay, well, it essentially doubles our potential max development. So yeah, pretty cool outcome and something to consider.
Yeah, I'm having a cheeky smile. Sorry, not to take away from the message, but no, we've got our classic webinar heckler, Steve Clark. Thanks for dropping some golden nuggets directly. You can't see the message directly to us, but we've neglected the chat a little bit here. But I just want to check the slides. How are we going there?
So we're actually going to switch into Q&A, and before we sort of take questions, just a reminder: if you're a client, reach out to your accountant who you work with at Inspire, and just have a chat to them about any questions to debrief from this. If you are not yet a client or you want to explore working with us, then the way to do that is to book in a strategy call with one of our team, and we can debrief from this webinar or wherever you'd like to go with that. But yeah, we work predominantly with or solely with business owners, property developers being one of those categories. Alrighty, so Steve, just to answer your first cab off the rank, Riz would be okay to have this unrelated suit with, even though he might call him a brother.
Yeah, we're not blood brothers, but I would be considered unrelated to you, Steve. I'll start from the top here. We've got Howard, just making some, I guess, notes here. Thank you for participating, Howard. Thank you so much. If there are different partners, I think this was when we were talking about having different partners own their units in different structures. You're right. If there are different partners and each one a different way to hold the units, that's kind of each to their own. And there are some limitations sometimes. And that's where when we talk about doing this advice, it's not just about the central development entity, so to speak. We need to also, because the tax outcome is at the unit holder level, we need to make sure that you have the most optimum way of holding those units as well. And I've seen people kind of, do it in one hit. Let's everyone talk about it, but some people want privacy. So you can do it, all obviously separately as well. Interesting, in some parts of the UK, they start charging you double rates. Ouch! After a year, if the property is vacant, and this is where we talk about kind of rates and state-based laws. We want to make sure there's nothing surprising like that comes into play. So, getting a really good understanding of the land tax rules, the stamp duty, and even what Sunny mentioned there. There's some local government and council kind of contributions that you have to make as a developer because there's impact in terms of like when you use that piece of land, or when you're developing, there's impact to that council area. There's actually contributions you have to make as well, and that comes from a very astute and experienced developer. Sunny, I saw you've done a few developments at the top there, but then you want to take the next one there?
Yeah, cool. Yeah, so the next one is around what about each of the structures with losses? Each of the structures we gave were trusts, funnily enough. Now, if a trust makes a loss, it's sort of stuck in that trust until some sort of profit or income gets it out of there. So, yeah, Howard, that's your sort of simple answer. Yeah, that's
And there is also two different types of losses as well. Obviously, we've got the income tax losses, and we've got the capital losses as well. Yeah, let's hope there's no losses. That's probably the best thing we can do. But if there is, things happen. It's just about understanding how that can be quarantined and carried forward into future years until such time there's either a capital gain to offset capital losses, or a profit to offset income tax losses that comes through there.
Yeah, perfect. All righty. Well, hey, that's all the Q&A. Actually, I'll just check the Q&A box. There's a couple more here.
There's a couple there.
Aren't cousins allowed? Craig Rigby has asked that question. That is a technicality. I've looked into that before, and this is from the unrelated unit trust. My understanding is cousins are allowed, but again, just quadruple check, because if you get that wrong and you fall into the related with anyone you're involved with, then you might find yourself in trouble. And if you're probably not going to have the cousin as your shareholder directly, it might be one of their trusts. Again, you want to do tests on the trust itself, or whatever the shareholder that they're going to invest in as. And then Howard, this is early on. Is it worthwhile setting up a structure for each development? Yeah, absolutely. There's some clients we've got that sort of repeat developments in the same entity, but usually they're finished one beyond and then on to the next one. But the big reason why you want to do a fresh structure is just, mainly asset protection. If something goes wrong in the previous one, you don't want that to affect your current one or your new one. That'd be my massive reason why I wouldn't do it in the same entity.
And especially if you have different owners in it, different percentages, different people might want to be invested at different levels. It might be 1/3 at the start, and then as time goes by, life changes, someone might want to be 2/3 instead. And that's where you don't want to complicate that with kind of existing structures and doing that. It's better off just to call it quits or wrap it up, cash out the poker table and then start a new one.
Awesome.
Yes, Howard, unless you have losses to recover. Yeah.
Yeah.
Good point.
Yeah.
Good point.
Oh, a few questions coming through. Alrighty. Justine's asked, could you use super money to build a house on land you already have and rent it out? So if you owned the land outside of super, like Justine, with that sort of scenario, it'd be worth us getting a bit of a better understanding of what you're trying to achieve there, who owns what, and then if your intention is to rent it out, then there may be some sort of strategy for you there. But yeah, we'd probably need to know a bit more on the exact situation for that to happen. A little bit easier if the SMSF or superannuation fund already owns the property. But again, there's rules around that even. So we need to make sure we're not changing the nature if it's got lending. And yeah, it's not such a straightforward answer. But yeah, Justine, just reach out and we can help you with that. All right. Any companies that do developments that take on clients worth checking out? Yeah, none that we've got clients who do it, but that's an extremely high risk referral. I'm really not sure where to start with that question. Apologies.
Yeah. And I think without referring anyone, I think there are, I have seen people kind of do that. They either run courses or they take you through a process as a consultant and all that stuff. The hard part about that is like you just don't know. You just don't, because as a developer, when you're developing the property, you have your own skin in the game, and you're making those decisions when you have a consult. I'm not saying they're good or bad here. What you want to consider there is that it might be that they're just looking, it's a fee that you pay to get it done. It's getting someone to kind of look over it and help you. You just want to make sure that if, like any developer or even off the plan purchase, just look at historical stuff that they've done, get some testimonials. Don't just kind of look at their marketing and go for it. Obviously, that might be something that's already, that's something that you already know there, Jay.
Yeah, cool. Well, we might wrap up there, actually, Riz. So yeah, no, we might finish up there. But hey, I just want to say a final thanks to everyone who's joined today. And yeah, if you're not following us yet on Facebook or Instagram, maybe YouTube, then feel free to hit the follow button. And thanks, Tay, for posting those links there. But yeah, if you want to get in touch, as I mentioned earlier, pop a booking in for a strategy call, and we can have a chat to see how we might be able to help you. All righty. Thanks everyone for joining.